If you think silver's price is set in New York or London, you're already behind. Right now, a quiet shift is happening halfway across the world. A shift so powerful, it could rip the silver market out of its old rules and launch the next major breakout when almost nobody is positioned for it. This is the story Wall Street isn't watching, and why Shanghai may decide silver's future. For decades, silver traded inside a familiar cage. Paper contracts in Western futures markets dictated price. Supply and demand stories were filtered through derivatives, leverage, and financial engineering. Physical metal mattered, but it was always secondary. That system trained investors to look west, to watch the COMEX open, to react to New York volume, to assume that's where real price discovery happened. But that assumption is quietly breaking down, and silver is where the fracture is becoming impossible to ignore. China doesn't approach commodities the way the West does. It never really has. Instead of treating metals as trading vehicles, China treats them as strategic resources, inputs, foundations for industrial power. And silver sits right at the intersection of where China's priorities are accelerating fastest: energy transition, electrification, advanced manufacturing, and supply chain security. Solar panels, EVs, grid upgrades, electronics, all of them consume silver. None of them can substitute it easily. That alone would matter, but what changes everything is how China is choosing to source and price that demand. The Shanghai Futures Exchange and the Shanghai Gold Exchange operate under a different philosophy. Physical delivery matters, inventory matters, premiums matter. When demand rises in Shanghai, it doesn't just express itself through speculative positioning. It shows up in higher spot premiums, tighter availability, and sustained physical buying. That is fundamentally different from the Western paper-driven model where massive short positions can cap price even as physical demand screams higher. This is where the great decoupling begins. For the first time in modern silver history, we are seeing persistent periods where Shanghai silver prices trade above Western benchmarks. Not for hours, not for days, but structurally. That premium is a signal. It asks the market saying physical silver in Asia is worth more than paper silver in the West. And markets always follow the place where real scarcity shows up first. Think about what that implies. If Chinese buyers are willing to pay more to secure physical supply, then the global flow of silver starts moving east. Refineries adjust, export routes shift, vaults drain. Western exchanges can print contracts, but they cannot print metal. Eventually, the paper price has to reconcile with the physical reality, or the system fractures under its own weight. This isn't about a single headline or a one-week spike. It's about control. Price discovery is migrating toward the market that actually consumes the metal. That's how oil pricing shifted over decades. That's how rare earths became geopolitical. And that is how silver is slowly being pulled out of the speculative echo chamber and into a demand-driven regime that doesn't care about Wall Street narratives. Most investors miss this because they're trained to watch charts, not flows. They see volatility and assume manipulation, or they see weakness and assume the story is broken. But beneath the surface, Shanghai is absorbing metal, setting marginal prices, teaching the market what silver is really worth in an industrialized, electrifying world. And when price leadership shifts, it rarely announces itself with fireworks. It happens quietly, persistently, and then all at once. That's why this moment matters. Because the great decoupling isn't about silver going up tomorrow. It's about who sets the rules when it does, because once price discovery escapes the paper cage, it doesn't come back. History shows this again and again. When the center of gravity moves, markets don't politely negotiate. They snap. And silver is uniquely vulnerable to that snap because its market is small, thin, and wildly leveraged compared to its real-world importance. Here's the uncomfortable truth most Western analysts avoid. The silver market only works as long as most participants never ask for delivery. Futures contracts outnumber available physical metal by orders of magnitude. That's manageable when confidence holds and when demand is mostly financial. But it becomes unstable when a large price-insensitive buyer starts pulling metal out of circulation. China doesn't buy silver to flip it next quarter. It buys to use it, to lock it into infrastructure, factories, panels, and grids that won't be melted back down just because prices move. Shanghai's growing influence exposes this weakness. When Chinese buyers pay a premium, arbitrage should theoretically balance prices. Metal should flow from where it's cheaper to where it's more expensive. But that mechanism only works when there's enough free-floating supply. What happens when inventories are already tight? What happens when Western vaults look full on paper but thin in reality? That's when premiums persist. That's when decoupling becomes structural, not temporary. We've already seen early warning signs. Deliverable inventories at major exchanges fluctuate in ways that don't match reported demand. Lease rates spike quietly. Backwardation appears where it shouldn't. These are not random anomalies. They're stress signals. And Shanghai is acting as the pressure point that brings them to the surface. At the same time, China is reshaping how it manages commodity risk. Instead of relying on dollar-based systems, it's building parallel pricing mechanisms, UN-settled contracts, bilateral trade agreements, direct sourcing relationships with producers. Silver fits perfectly into this strategy because it's both industrial and monetary adjacent. It's not just a metal. It's optionality. Insurance against supply disruptions, insurance against currency volatility, insurance against a world where access matters more than price charts. Meanwhile, Western markets are distracted, obsessed with rate cuts, CPI prints, and short-term positioning. Silver gets treated like a leveraged bet on gold or a macro trade that failed to deliver. That complacency is dangerous because while traders argue over technical levels, physical demand is quietly redefining value underneath them. This is where breakouts are born, not from excitement, but from tension, from a widening gap between what paper says something is worth and what real buyers are willing to pay. When that gap grows large enough, price doesn't adjust smoothly. It gaps, it overshoots, it shocks people who thought they had time. The great decoupling is still early, that's why it feels invisible. But every ounce Shanghai absorbs tightens the spring. Every premium reinforces a new reference point. And once enough market participants realize that the old signals no longer apply, behavior changes fast. Shorts scramble. Hedgers reprice risk. Producers rethink forward sales. Suddenly liquidity vanishes right when everyone wants exposure. This is how silver stops trading like a side character and starts acting like a strategic asset again. Not because sentiment flipped, but because the world using it decided the old price no longer made sense. And when that realization spreads, it doesn't wait for permission from New York. It moves through supply chains, pricing desks, and balance sheets faster than most expect. When that shift accelerates, silver won't ask whether traders are ready. It will simply reprice to where the real demand already is. What makes this moment especially dangerous for skeptics is how asymmetric the setup has become. Downside feels familiar. People think they've seen silver disappoint before. Upside, on the other hand, is poorly modeled. If Shanghai continues to lead, the Western market won't just follow, it will chase. And chasing in a thin market is how violent moves happen. This isn't a slow grind higher scenario. This is a reset scenario, where price jumps to close a gap that should never have existed in the first place. Consider how quickly narratives change once price starts moving. Suddenly, the same commentators who dismissed silver rediscover industrial demand. Headlines shift from apathy to urgency. Inventories that were ignored become front-page data points. That's not because the fundamentals suddenly appeared. It's because price finally exposed them. Shanghai doesn't need the story to change first. It forces the story to catch up later. There's also a geopolitical layer most investors underestimate. As global trade fragments, countries prioritize secure access to inputs that power their economies. Silver isn't oil, but it's becoming just as critical for electrification. If access tightens, price becomes secondary. Availability becomes the real constraint. That's when market logic flips. Buyers stop waiting for dips. They buy to secure supply. That behavior alone can overwhelm paper pricing models that assume elasticity where none exists. This is why the great decoupling matters beyond silver itself. It signals a broader transition in how commodities are valued. Less leverage, more delivery, less narrative, more reality. Shanghai represents that shift, not perfectly, not instantly, but directionally. And markets move on direction long before they arrive at the destination. The irony is that silver's long underperformance is what makes this setup so powerful. Expectations are low, positioning is light, belief is thin. Those conditions don't prevent breakouts, they enable them. When leadership changes and scarcity asserts itself, price doesn't need permission. It just needs one market to say, this is worth more. Shanghai is already saying that. And when enough metal leaves the Western system, when enough premiums persist, when enough contracts quietly settle in cash instead of delivery, the illusion breaks. At that point, silver doesn't need hype. The math does the work. The only question is how many people recognize what's happening before the adjustment forces them to. This isn't about predicting a date or a target. It's about recognizing a regime change while it's still unfolding. The great decoupling isn't loud yet, but it's real. And if history is any guide, the biggest moves always begin where almost no one is looking. In the end, silver's next major breakout won't come from a chart pattern or a Fed meeting. It will come from a shift in who decides value. Shanghai isn't asking for permission. It's buying metal, setting premiums, and pulling price discovery toward reality. When that process completes, silver won't just be higher, it will be different. And by the time the crowd realizes the rules changed, the breakout will already be behind them.